Music fades in and out. Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze opportunities. Today, we're dissecting a very specific name that's been lighting up our screens, Wearable Devices Limited, ticker symbol WLDS. We're talking about a stock with some truly eye-watering cost-to-borrow fees and explosive recent price action. So, buckle up because we're going to break down exactly why WLDS is on our radar. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Image, WLDS logo or product shot. Let's start with the basics of WLDS. Wearable Devices Limited operates in the exciting technology and consumer electronics sector. This company is at the forefront of developing a non-invasive neural input interface, essentially allowing users to control digital devices using subtle, touchless finger movements. Their core offering includes module development kits, which enable control over everything from consumer electronics to smartwatches and smartphones. With a current market cap of just $9.03 million, WLDS is firmly in microcap territory, meaning it can be prone to significant volatility. What is cost to borrow and why it matters? Animated graphic, cost to borrow with percentages rising. Now let's talk about one of the most critical metrics we track, cost to borrow, or CTB. In simple terms, CTB is the annualized interest rate that short sellers pay to borrow shares of a stock so they can sell them. They do this hoping the price will drop, allowing them to buy the shares back at a low price, return them to the lender, and pocket the difference. But here's the kicker, if many people want to short a stock, and there aren't many shares available to borrow, the demand for those shares drives the borrowing fee incredibly high. When you see fees climbing into the hundreds or even thousands of % annually, it's a huge red flag that something unusual is happening in the stock supply and demand dynamics for short interest. Why this stock is hard to borrow right now. Graphic, WLDS CTB numbers prominently displayed. And WLDS is a prime example of exactly that. This stock appeared on our hard-to-borrow screener for a very compelling reason. Its annualized cost-to-borrow fee is a staggering 949.3%. Think about that, short sellers are paying almost 1,000% per year just to maintain their short positions on WLDS. Why is it so high? A key factor is the estimated float, which stands at a tight 1.9 million shares. A small float means fewer shares are available for trading and borrowing, making it much easier for borrowed demand to overwhelm supply. While the exact number of shares currently available to borrow is unknown at this moment, a CTB like this strongly suggests the supply is extremely constrained. Our internal composite squeeze score for WLDS is currently 52.0, indicating a notable, but not extreme, potential for squeeze mechanics to play out, largely driven by this massive borrow fee. Squeeze mechanics explained. Animated graphic, price chart with short squeeze event highlighted. So, how does a short squeeze actually work, especially with a stock like WLDS? Imagine you're a short seller, and you've borrowed shares of WLDS at high cost, hoping the price will fall. But what if the price starts going up instead, as WLDS has been doing? Your losses begin to mount, and your brokerage might issue a margin call requiring you to deposit more cash or close your position. To close a short position, you must buy shares back from the open market. When many short sellers are forced to buy back at the same time, this creates a surge in buying pressure. This sudden demand can propel the stock price even higher, forcing more short sellers to cover, which in turn fuels an even bigger price spike. That's the short squeeze. While a high CTB certainly increases the pressure on short sellers, it's crucial to remember that it does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price is due for a fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. Graphic, dilution risk, low. One of the biggest threats to any potential short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can provide liquidity for short sellers to cover their positions without driving the price up, and it also spreads the company's value across more shares, typically lowering the per share price. We've performed our dilution risk check for WLDS and found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. This is a positive sign for any potential squeeze thesis, as it reduces the risk of new shares flooding the market and undermining bullish momentum. Recent reverse split watch. Graphic reverse split, WLDS 1-3 on June 22, Another important factor to consider for WLDS is its recent reverse stock split. WLDS executed a 1-for-3 reverse split on June 22, which was approximately 45 days ago. For those unfamiliar, a reverse split reduces the number of outstanding shares and proportionately increases the share price. So, for every 3 shares you own, you now own 1, and your per share price is 3 times higher. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. This isn't a guaranteed outcome, but it's a pattern we've observed in some names as the market digests the new share structure and price point. The timing here, 45 days post-split, puts WLDS just outside that immediate window but still within a period where the market is adjusting to the new float and price dynamics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Chart WLDS 30-day price and volume. So, what should you be watching with WLDS? The recent price action has been nothing short of explosive. Today alone, WLDS is up an incredible plus 46.71%. Over the last 5 days, it's gained plus 65.62%, and looking at the last 30 days, WLDS has surged by a massive plus 138.20%. This kind of upward momentum combined with its sky-high cost to borrow is a potent cocktail. Volume has also been significantly elevated. Today's volume for WLDS hit 8,239,600 shares, which is 2.7 times its 30-day average volume of 3,052,123 shares. This increased volume confirms significant market interest and participation. For those following WLDS, continue to monitor the cost to borrow fees, observe the available shares to borrow if data becomes available, and keep a close eye on price and volume trends. Any further increase in borrowing costs or a significant drop in available shares could further amplify the short squeeze potential. Music swells. WLDS, Wearable Devices Limited, with its innovative technology, microcap status, and that truly extreme 949.3% annualized cost to borrow, presents a compelling case study in hard-to-borrow stocks. Add in the recent post-reverse split period and the explosive price action, and you have a stock that demands attention purely from an educational standpoint of understanding market mechanics. Remember, this is about understanding the dynamics, not making predictions. If you found this deep dive into WLDS insightful, please hit the like button, subscribe for more unique stock breakdowns, and let us know in the comments what other stocks you'd like us to analyze next. Until then, stay informed, stay smart, and we'll see you in the next video.